After trading for 6+ years, trying every single strategy under the sun, backtesting day and night, all just to end up stuck at the same place, I realized that strategy alone isn't enough to make you consistently profitable, and you need to be able to adapt your strategy to every market condition in order to sustain your profitability. See, every strategy has certain conditions it performs very well in, and every strategy has certain conditions it doesn't perform well in. The problem is, most traders do not know how to recognize these conditions, and even if they do recognize them, a lot of times it's too late and they're already too frustrated and they end up blowing up the whole account. So in today's video, I'm going to show you how to actually identify good conditions for your strategy versus bad conditions, and how you can adapt your strategy to each of these types of markets and actually keep and multiply your winnings. And this is the same exact thing I teach my one-on-one students to become insanely consistent in the markets. So without further ado, let's go ahead and jump in. Alright, so we're at the computer now, so let's go ahead and look at the actual presentation. You can see this here. This is when and when not to trade, and this is specifically going to be for my top and bottom tick strategy, but this can be adapted to any strategy. So in these examples, what's going to work best for the top and bottom tick might not be what works best for your strategy. Maybe your strategy is better in consolidation. Maybe your strategy is better when it's explosive or ripping. We're going to cover all of that, and by the end of this video, you're going to know exactly where your strategy fits in regards to these categories. And along with that, I'm going to be teaching you how to actually identify each of these market conditions based on price action, based on certain news events, etc., etc. And then we'll dive into actually how to trade each of these conditions along with what type of risk you should be using. So first and foremost, guys, is we need to understand market conditions. Now, what are market conditions? Well, there's pretty much 3 different conditions the market can be in, and that is chopping around or ranging, smooth or trending, or explosive and just ripping in one singular direction. And the way we identify which condition we're in is based on price action and order flow, high impact news events, and seasonal tendencies. So these are the 3 factors that influence the market conditions. Now, as I stated before, every strategy has conditions that are most ideal and least ideal for that specific strategy, and understanding which conditions your strategy performs well versus not is a key component of being profitable for the long term. So without further ado, choppy and ranging markets. Now, how do you identify this? Well, it's pretty simple, guys. This is simply when candles are closing side by side and we're not really making any higher highs or lower lows. If we are, we're certainly not closing outside of the range. So when does this happen? Well, this happens usually when a weekly level gets hit for the first time. So if we look up here, you can see this example. We had this previous week's high right here, and you can see as soon as that previous week's high actually gets touched, this is now the 4-hour time frame, you can see we begin to consolidate. So as soon as we tap that, automatically we start barcoding, consolidating, and this creates a huge mess, and it is very hard to trade this if you're looking for a clear PD array. So that is one time when consolidation tends to happen, is whenever we touch a fresh weekly level for the first time. Other than that, just whenever you see candles closing side by side in a barcode, a lot of back and forth wicks and indecisive candles, that is another clear sign. And additionally, the market usually keeps price away from external liquidity, so you'll oftentimes notice the most extreme high and low of the range doesn't get touched. And if we look at some examples of this, you can see right here, you see the extreme high up here, extreme low right here. Price doesn't go for either of them, just continues to chop around in between this range, and it doesn't respect any of the PD arrays that are lined up here either. And you can see up here as well, very barcoded side-by-side candles, a lot of wild wicks, and no real respect of any sort of trend. So these are the key things that you also want to be gathering in your own screenshots, because it's going to make a world of a difference when you know exactly what certain conditions look like. And that's the main way you can start to avoid some of these as well. And then this also happens when we have too many opposing PD arrays crowded together. So if there's bullish and bearish PD arrays all on different sides, it's very hard for price to go anywhere. And you can see by this example right here, this is the daily chart. See, we have a ton of different bearish levels, ton of different bullish levels, and whenever this happens, price just doesn't really know where to go. Simply creates new levels on top of itself, and the more it passes through, the more confusing it usually gets. You can just see on just the 4-hour time frame just how crazy this is as well, because price is just confused. It's trying to make a move, but it keeps getting obstructed by all of these contradicting levels. So in these cases, you really just have to wait for displacement outside of this area entirely and for price to create some new levels for you to use. Now, some other causes of consolidation or choppier conditions is the day before most red folder news events. So the day before FOMC, day before CPI, day before NFP. These are classic consolidation days because the market is holding price in a pattern, preparing for the upcoming news release. And if you don't believe me, just backtest it. Go on forexfactory.com, look at the most recent days before FOMC, CPI, NFP, and you'll probably notice they're very choppy, very consolidated 80 to 90% of the time. And some other days where it's usually common for this to happen are some non-news Mondays or the day after a bank holiday. And I believe some of these examples up here were actually the day after bank holiday or bank holiday itself. And then seasonal tendencies, usually between New Year's and mid-February, there's a lot lower volume. A lot of the big banks, institutions are on vacation, so it could be a little bit lower volume, creating smaller ranges and choppier conditions. And then August and other summer months are sometimes very, very common for price to consolidate or just move very choppily. And then last but not least, times of uncertainty, black swan events, anything like that. If we do not explode in the market or dump in the market, chances are we usually consolidate because people don't invest heavily whenever there's uncertainty. So these are all the different ways that you can either identify, predict ahead of time, or just analyze right in the moment to let you know that, boom, I am in consolidation, I'm in choppy waters. Let me adapt accordingly. And how exactly do you do that? Well, let's go ahead and find out. So if there's choppy ranging conditions, obviously there is no trend, so you don't have to be counter trend or against trend. But in this case scenario, you just use no risk. So for me personally, I do not trade at all whenever we're in pure consolidation because, what's the point? You don't have higher time frame levels or direction. You don't have intraday direction. You're just trading lower time frame patterns. And we're not pattern traders over here, guys. We're smart money traders, so we do not do that. So that is how you adapt to choppy conditions. And if you can identify this, guys, if you could do this is the one thing that took me from going on tilt. And no matter how many payouts I got, I can never keep them and not give them back to the market because I didn't understand how to identify and adapt to choppy ranging markets. And when I looked through all my data, every single time I blew an account, it was usually down to one of these factors, if not all of them at the same time. And then moving on to smooth and trending markets. How do I identify smooth and trending markets? Well, a couple different ways. The first indication is clear one-sided price action, and that means you cannot argue against it. So if you have bullish order flow and it's so clearly bullish that you can't possibly argue a bearish scenario for it, that is the ideal trending conditions. And of course, clean, efficient price legs. Everybody knows higher highs, higher lows, or lower highs, lower lows. So just clean stair-step price, not a lot of back and forth, not a lot of displacements down in the opposite direction, or indecisive price action. And a lot of times this happens when the higher time frame and intraday directions align. That's when it's usually the strongest, and whenever the market is running efficiently to clear draws on liquidity and external targets. So whenever there's just a clear target, most of the time a higher time frame target, it's near current price and we're just absolutely ripping to it, that is when these conditions tend to happen. And you can see here by this example, you can see very, very smooth price action. We displace, market structure shift, form a bullish price leg, retrace to the order block, fair value gap, another price leg, retrace, etc., etc. And even on the way up here, boom, retracement up here, and then even on the way down, quick retracement down, and just very smooth passes, guys. No back and forth, choppy candles, not taking forever to make price runs, just very smooth, very easy conditions, and it's very obvious to read. So that is exactly what you're looking for. And then if you're wanting to use the fundamentals to help you to identify when these days are likely to happen, just look to high impact news. So most red folder news days are going to offer you some pretty good volatility where this can happen, as well as middle of the week, Monday and Friday, especially if there's no news, tends to be a bit more consolidated. So the middle of the week offers some of the bigger movements and some of the opportunities to catch the trend. And other than that, when the money printers come on, whenever they lower interest rates, whenever people are just pouring cash into the market, of course that makes the market move pretty smoothly, pretty one directional as well. So those are things you can look for in terms of fundamentals. And in terms of seasonal tendencies, usually around December, there is a December rally. A lot of people call it the Santa rally. That's when all the institutions are trying to look good for their investing clients. So they inflate the market, they send it up, and usually you can just buy. And then also spring into summer, usually pretty clean, but it is kind of hit or miss this year. But ultimately that springtime, early spring, transitioning into summer before it gets a little choppy is typically pretty smooth. Now, how do you adapt to trending conditions? Well, for top and bottom tick model, these are usually the easiest conditions to trade in, so there's not much adapting we have to do. However, in order to get the highest probability, there are things we have to do to adapt to it. So you can see here, one of the main ways, and the way that I do it, is you are either with the trend or against the trend, or in other words, counter trend. So how do you identify the trend? Well, we covered it, guys. It's higher time frame order flow, intraday order flow, displacements like we had in this example over here. So this is exactly what we're looking for. So obviously in this scenario, we're in a bullish trend, so we want to be looking for a bullish position. So if we are with the trend, the probability is higher, so we can use full risk. I can go ahead and use a standard position size. I may even be able to go a little heavier depending on the quality of the setup. And then if it's against the trend, I could either opt for half my usual risk to play it safe, or I can just play it completely safe and not take a trade at all. And sometimes this is the better decision. But either way, if the worst case scenario happens, you didn't put on full risk and you're not taking an unnecessary full loss. And if the best case scenario happens, well, you still made a good multiplier on whatever you decided to risk. So it is a win-win situation whenever you decide to scale down when you're not fully sure. So that is the first two. Now the last one, guys, and this is one that's very, very bad for top and bottom ticking. I would recommend just avoiding this entirely, but that is explosive or ripping conditions where price is just absolutely ripping in one direction and just disrespecting every single area that is opposing to it. How do you identify this? Well, explosive conditions is usually after we're very overdue for a retracement on the higher time frame, especially after doing a huge rally. So if we just shoot up on the 4-hour, daily, weekly, and we leave a bunch of fair value gaps, leave a bunch of imbalances, and we do not retrace for a very long time, when that move eventually does retrace, it is likely going to dump through all of the levels. And we'll show you what we mean on the chart in a second. So you can see right here, this is the daily chart, and you can see in this particular time we're absolutely ripping up. That's more than 10 days in a row of strictly bullish candles. We left behind a ton of imbalances, ton of discounted levels. And you can see price is just nearing the point where it's ready to retrace, and when it finally does, tears through every single fair value gap, every single imbalance, new day opening gap, order block, absolutely everything. It just tears through it. So if you were trying to go long, which many people did within these 4-hour order blocks, you are going to get absolutely destroyed, and you're going to get frustrated. You're going to keep trying to go long, and it's just not going to work no matter what. So in these conditions, you just have to accept it. You have to accept the conditions you're in. A lot of times after I take 2 losses in a row going for the same direction, I just simply stop looking for trades in that direction, or simply stop looking for the day. But that is a very clear example of when you should avoid going in the opposite direction of price, and that is explosive and ripping conditions. Other than that, this usually happens on high impact news days, red folder news days, where price action conditions above are present, and we also have either FOMC, NFP, CPI, any news event with 2-stage delivery. And in terms of seasonal tendencies, this could really happen at any time. It's more based around the technicals, but whenever we have a black swan event or just something very unexpected and the market crashes, this can also cause this as well. So what do you do whenever you have these conditions? Well, if you're with the trend, you simply put on full risk, you go with the trend. It's not a big deal, but oftentimes whenever this happens, we don't do a whole lot of retracing. So even if you do have good levels that align with the direction, chances are price might not even revisit them. So I say that with a grain of salt. And if you're against the trend, if you're counter trend, obviously you don't want to risk at all. You don't want to take any trades. If you spot it early, don't trade. If you get caught in it and realize it after a couple losses, go ahead and cut the day short. But that is how you adapt your strategy to market conditions, guys. And this is how you stop being those traders who win, get a payout, and then give it back and get frustrated and go into debt. And then they're back in the hole again, and they just repeat this hamster wheel over and over and over again because they never figured out how to handle the rough patches, and they never never figured out how to actually adapt the strategy they're using to changing market conditions. And as we know, market conditions are always changing. So if you can't adapt, you're never gonna last for long. But anyways, guys, appreciate you tuning into this video. Hope you got value out of this. I went super hard on this board as well. So if you want to go ahead and screenshot this, make sure you do that. And make sure you actually collect these examples in your own trading as well. Don't just take my word for it. Go out there, test this stuff, compare and contrast it, pull up your own setups, see if it matches this, and go ahead and let me know how that goes. Thank you for watching this video, and if you made it to the end, be sure to drop a comment, like if you learned something, and subscribe to the channel for more content like this. Go give this strategy a try, and other than that, if you want to work with me one-on-one, I am opening up a few more spots this month, so if you want to apply for that, go ahead and click the link in the description below. But until next time, be safe, God bless, and I will see everyone in the next video.